Let's get started. Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this session today on interactive options trading with a professional trader. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. A few housekeeping matters. The session today will last approximately 1 hour. This format will be different from our past webinars, where our speaker will try to address your questions throughout the webinar instead of at the very end. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar. And to tell you briefly a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we love and specialize in options trading. We offer you some of the lowest rates in the country, including zero commission on stocks and ETFs, and options are just 10 cents per contract. We also offer an easy-to-use trading platform, as well as free trading tools to help you identify option trading opportunities. So before we start our presentation, I'd like to walk you briefly through our disclaimer. If you could just take a moment to read this. Options may carry a high level of risk and may not be suited for all investors. And certain requirements must be met to trade options through eOption. There is a booklet called The Characteristics and Risks of Standardized Options. And if you'd like a copy, you can click on the link below and get it on the website, or you can also contact us at eOption and we're happy to send you the booklet. But we encourage you to read this carefully before you decide to participate in options trading. I'd also like to stress that this webinar is for educational purposes only and should not be considered a recommendation or advice by eOption or InvestTrade or Regal Securities or the presenter. I'd like to turn our attention to our speaker now, Teddy Keckstadt. Some of you may recognize his name from past webinars he's done with us, and he's one of our most popular speakers. We'd like to welcome him back today. And something new we're doing, you can also see Teddy on your screen in the little video box. So you'll be able to see him live. And Teddy's a professional trader, and he has over 30 years of trading experience. He's traded on the Chicago Board of Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he is the author of High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and thank you, everybody, for your time for the attending this webinar today. And for everything I do when it comes to webinars, I put up my own company disclaimer as well. I'd like you to just take a look at it. It's the same thing that Gina basically said, that this webinar is for illustrative and educational purposes only. So, and that you need to understand the risk before you get involved with any type of trading endeavors. All right, so let's get ready, all of you bulls and bears out there, and let's get into this webinar. All right, so we already have the eOption trading platform pulled up. This is obviously the paper trading version. And as we get through some different techniques and strategies and how to use the platform and break down trades and things like that, you can leave questions in the chat box and I will try and get to as many as possible. And we'll we don't want to go into totally chaos. So I'm going to drive what stocks we're going to talk about today and what options we're going to use. And then we'll ask questions as we get through each little step. Okay, so just real quick, you want to take a look at the trading platform. Right here, we have your account summary. So every day when you log in, it'll tell you what your account value is. Currently, there's no positions. So you can see here, positions symbol, there's no data available. It's because all the trades are gone. It does have here orders. These were all past orders from our past webinars. Ever since this beginning of this year, we've been using an interactive trading platform here for our strategies to show you how easy it is to implement different things as far as which direction you want to be, a bull, a bear, for beginning traders as well as advanced traders. So along the trading platform, you have your daily outlook, which we're going to get to in a little bit. There's a watch list as well. So you can have different stocks that you're looking at and you're monitoring to may not have a trade on in them, or maybe you do have a position on in them. So you can set that up and it's very functional for different, and you can cater it to your own user needs. Then there's a charting section as well. We have a research tab, and then we have option chains. So option chains, obviously, there's a lot of things when you're depending on how simple or how intricate the strategy you're using, you'll be looking at various chains, especially because you're looking at the different expiration months or weeks, depending on what type of option you're talking about. And we'll get into that. Then you have your trading tab, you have your positions and orders, which will tell you what positions you have on already and orders that are resting in the marketplace. You have a news tab, you have a screener, so you can do all kinds of screening of stocks. And then you have options play. Now this one you can't see on this because it's not an open account trading platform, but for options play, it's available for all live accounts. I seriously suggest that you check it out on their website and get some information about it. It's a really helpful tool. Obviously, you can open account. You can also set alerts. So when the market actually triggers off at certain levels in the stock market or in your options, it'll let you know. All right, so let's start out with our daily outlook. Okay, so we have daily outlook here. It gives you a little broad base information about the markets and stuff like that, the major indices and what have you, a little world news. It tells you about the calendar events. It's very important to always know what kind of numbers are coming out, you know, especially like a day like today, you have a G7 meeting and you had the Fed chairman speaking there. Kind of a day that usually will sometimes put a pause on the market, especially when he's talking. So now we're going to look at a couple different stocks here, and we have sector breakdowns here, which is really nice. Oops, I don't know where my mouse, I clicked the one button on accident. Sorry about that. So we're going to start out with the consumer sector, and from this little array of stocks here, I already looked at McCormick. I heard that being talked a lot about last night and also this morning. So I figure, you know what, why don't we check out and start out with that? Okay, so we're going to go to this chart here and put in the MKC symbol. Okay, so we have the McCormick. I'm going to clean this up and make it a little bit bigger for you since we're on the Zoom meeting. So this here has a bunch of other little technical stuff, but we're not going to get into that. All right, so if we look at McCormick, you can see that today's session, it had quite some volatility, and right now it's slightly positive on the day, trading right around $85.83. Now, remind you once again that this is all in delay between the feeds through Zoom, the data coming into the platforms, and once again, this is for educational purposes. Don't try and mimic anything that we're doing here. We're going to go step by step and break down, though, what kind of trades we might be looking for. All right, so McCormick, so we look at the trend here. You can obviously see on the daily basis, we're making lower move lows, lower move swing highs. The market is trending lower. Obviously, we have some big news today with earnings and all kinds of other things about McCormick. Today's volatility, you can see there was quite a little range compared to most days on this chart. Also, it gapped lower from yesterday's trading as well. Very interesting. So we came off of yesterday, which was now officially a new lower move high, and the market was trending lower to try and make a lower move low. So interestingly enough, today we almost did come close to those lows. So let's try and figure out maybe what kind of movement we can expect or is very likely to occur. Okay, so we can see that the trend is going down, obviously from the way the highs and the lows are going. So now we're going to take a little number here from Fibonacci. We're going to go back to this last highest high on the chart and try and just find a couple of potential target levels. So for those of you who are not familiar with Fibonacci, it's a way of figuring out different pivot points and support and resistance areas. So we're going to start out with the 50% and the 0.618 and also the 0.382. So when markets trend, not that they hit these points to an exactness, but for instance, as you're trending, making lower move lows and lower move highs, that's how you know you're in a trend. When you take out that, when you break that sequence, that's when you know that a trend is either changing or at the very least neutralizing. And this is important for gauging about when you have, whether you're owning a stock like McCormick or whether you don't want to own the stock, but you want to put on an option strategy. And we're going to figure out a couple of strategies where if you own McCormick stock, what would be the kind of things that you might want to be interested in putting on, and also if you don't have the stock as well. All right, so in this case, the market's been going lower. And if the market was to get, let's say, some buying pressure, these would be levels that we would be shooting for as far as upside targets. Now, the higher you go, the less likely you're going to get there because we're in a bear trend. It's more likely that we're going to actually come down and test this low. Why is that? Because so far we keep on making lower move lows, lower move highs. This is the key area right here from yesterday. Okay, so now we're starting to find some levels. Okay, and this is where we start to get into strike prices and strategies. So if you look at what's going on here from the recent history, now if we go to time frame, if we're going to use an option, whenever you put on an option strategy, unless you're only trading, say, for instance, a dividend release or an earnings announcement, then you may only trade an option that has an expiration of only a couple of weeks out. You're not looking to hold that option for very long. You're looking to get in on right before that news event and then get out afterwards. So either the market works for you or it doesn't. That's what's going to, your time frame is very short, but that's for that kind of move. You're most likely not going to be doing that, because if you're using an option strategy instead of using the stock, or if you have it, your time frame is definitely longer out there. Now, for looking for a move and for protection, right, one of the best areas is somewhere between 25 and 45 days out. Okay, so on the chart here, we're going to basically put this as a line here. We're going to find out. We're going to go back to our option chains here. So where we go, we got the watch list. We have option chains. So here we put in where the stock symbol is. We put in MKC, and now we can see the different expirations. Okay, so we have July, which is 16 days away. 16 days is not in our 25 to 45 day time frame, is it? No. So we go down to August here of 2022. Okay, and then we go in for up here expirations, August of 2022. We leave it as regular expirations. And for strikes right now, we're going to leave it all right there. So now what we have here is we have the beginning of our stock and what options we're going to line up potentially. Okay, so we have the MKC, the McCormick option chain pulled up here. We have 51 days to expiration. So it's a little bit more than 45, but it's not that much of a difference. All right, so we know that the market right now is trading right around $85. So that's right around this area here. We can see the different values for puts and calls, the different values, okay? So now that we figured out we have an August expiration, we know that it's 51 days away. So we're gonna go out here and we'll just put a vertical line out here into August. So we have a reference of how much time we have before the option is going to expire. Now we know that we have room for movement here. So the question is, what do we want to do? Well, if the trend is lower and you think the trend is going to continue, which unless there's a reason for a trend not to continue, like there's some change in management at McCormick or some big thing happens in the marketplace, whatever in their sector, all kinds of things can make the market move, whatever. So, but right now, the trend typically is your friend. So you'd be looking for bearish strategies and when to implement them. Okay. Now that would be if you didn't have any stock at all. Now, let's say you own McCormick right now. What would be some of the things you could do? Well, for right now, for instance, you could put on a covered call. Okay. So now a covered call is where you own the stock and you're going to sell out an option that will give you a little bit of a premium. So while the market is going lower and you're losing short-term value in your stock, you get paid a little bit of money to kind of pad that loss. Okay. Now, what happens if the market all of a sudden rallies through that? Well, in that case, then you're going to have an issue where your stock can get exercised, or no matter what, that you've locked in the value of where you're at. So let's look on the platform here. So we know we have August. Let's go to trading. And let's look at if we wanted to buy an option on McCormick. So let's say we own the stock already. So for each option represents 100 shares. So let's say you own 100 shares of McCormick. So it's trading right here at $85.97. Your position's worth a little over $8,500. Okay. So if you wanted to buy a call, then we go here, we go to the add an option. Okay. So this is where we start to look for it. So action right here, we're going to buy to open. Okay, so if we wanted to buy a covered call for this stock right here on McCormick, you would put here buy to open. Remember, you're initiating the trade, okay? Expiration, remember we found that August is going to be our expiration. We'll go to August 5th right there. And now it comes time to trying to figure out a strike price. Okay, so now the strike price is going to dictate how much value is in there and also where you're locking in your protection. So think of it like this. While the market's going down for your covered call, you're losing value in your stock. The reason you sell the call is to bring in a little bit of money and pad it. So now what your expectations is for this is that if you put on this trade, that between now and expiration, that the stock stays where it's at or it goes lower. You don't want it to go above the strike price, that's for sure, because if it does, that's when that can either get exercised or that's where the locked in premium is on. After that, you can't make any money on your stock because it'll be the call will be taking it away that you sold. Okay, so let's go back to the chart and try and find a strike price. Okay, so we know that the market's at 85, and we know that from the option chain, they're every, what was it? They were every $5 apart here. So we have an 85 strike price. So let's say you want to protect this, the market keeps on trending lower. So we don't want to get extra. So we don't want the option, the market to go above the option price. So let's look at the 95 and $100. We'll look at for $10 to $15 away. All right, so if we do that, and we go to, let's see, we'll go to 95. Let's put this as a price in here. Ordinance as a 95, there we go. Okay, so a 95 strike price would be all the way up here. Now, what is significant about this little area? Well, if the market does rally up to this area, well, it would be taking out this last swing high here, which would mean that it would be making a higher move high after making this higher move low today. That would put the market on neutral. So that would be positive for the stock, but not so good for the option position, okay? But there's a lot of resistance here. So let's say the market does come up into this area. It has to still get above this strike price here. So let's look at the 95 price here. So we go back to our trading, and now we have a strike price of 95. Oops, we got the wrong, might help to put MKC in here. My bad, sorry about that. Okay, so here we got the option to open and the expiration is August. All right, and now we have a strike price of 95. Okay, so now we're almost at finding the value. Now we know it's a call because you're going to be selling a call. Okay, so wait, we got to sell to open. See, that's why we go over these things. So we were initiating the position. We're selling to open a call, August expiration, 95 strike price. Here's what the cost is. So the market is 55 cents. So that would be $55. That would be what you would be taking in. So that would mean that right now, the market trading at $85 here, your position, you would get an extra $55 of basically, it's like just a little insurance, a little premium, not a dividend, but it's definitely just a little something. Okay. So this is not something that you're not hedging your whole position here. You're just padding your current downside loss, because let's say McCormick is a stock that you have complete faith in this company, and no matter what, you're going to ride this through whatever economic cycle there is, especially like when you have very long-term time horizons that you're looking at. Okay, so now we know we have a 95 level. It falls right before remember we had those little levels we found. There's a lot of resistance here. So we have this one here right at 91 and also at 94. There's also this last swing high here. So that means that there's a lot of pressure that's most likely going to be there. It's very hard for the market to get up there. That's the good thing about this covered call position. So in this case, if you implemented this trade, you would take the $55, and most likely between now and August, the likelihood of it getting above that strike price, the odds right now are very slim. Does that mean it's going to make new lows? Not necessarily. It could go sideways. It could make new lows and never even come close to this, in which case your stock value goes down and your option, you would have just brought in that little bit of $50 some for your option position. Okay. $55 doesn't seem like very much for an $8,500 position though, does it? So now let's try and look at what else could we put on. Okay. So we go back to our options trading position here, and we figured out, okay, we don't want to use this ticket. So now let's change this up. Okay. So let me just clear this real quick just to get that off there. So MKC. All right. So we're going to add another type of position, or we can go to a strategy. Okay. So now here's a good idea. What if we just want to know that sometime between now and August, the market, we don't know where it's going to go, but it may make, maybe it's neutralizing and we will make a run for this resistance. Good for the stock, right? If it goes down, well, then that's bad for the stock and you don't make as much money. So another idea might be to buy a straddle. Okay. Now a straddle is where you simultaneously buy one strike price together. Okay. So you buy a put and a call at the same expiration price. If we were to do a straddle, well, then we would be going right around at the market. So let's find 85 and we're going to, oops. Okay, let's change the color. So this makes it easier to see the strike prices. So we're going to go with this. There we go. Okay, so we have our 95 strike price and our 85. So for a covered call situation, we found 95 as an option to use. Could we have used less? Yeah, but the closer you get to the market price, the more likely your stock is going to spike above it. So that's one of the dangers of using a covered call. Now for a straddle, 85 strike price, that's a very interesting one considering where the market's at right now. And we'll see how this would work. So we're going to go here, we go to strategy. And we go to, let's see, short straddle, now long, butterfly, long ratio. Here we go. We go to a straddle right there, and it already sets up the platform for you. Okay, so now remember, the market's at 85.93. We figured 85 is the closest strike price to where the market is at. And we're looking at how to put on a straddle position now. Now, the straddle position is one that is a very neutral one. So the thing about a straddle is just like owning a stock, you don't want it to just sit there. So owning the stock, you don't want it to go down, but if it does go down, you're going to be losing equity. So your asset value depreciates, it goes down. Everyone understands that. If it goes up in value. Excuse me. So now, as far as the volatility in the marketplace, and also McCormick's all in the news about their earnings and what have you, and their projections for the next year. Who knows? Maybe it's a good thing. Maybe it's a bad thing. We don't know if the market's going to go up or down. A straddle doesn't care. It only cares that the market moves. So now when you put on a straddle, you're buying to open both contracts. Okay. And you are buying a put and a call at the same strike price with the same expiration value. Okay. So you can see that it's already lined it up. Remember how when I showed you the covered call position, when we started to enter it, we had to enter the expiration month, we had to enter the strike price, we had to enter the put value. So for this, we can change to August. There we go. And you can change other things if you want to do that. Okay. So, but that's already preset in there. I would go with the presets, typically, unless you're going, well, excuse me, except for when you go for your expiration months and your strike prices. Now we're going to stick with the 85. And then here we move that. Okay. So now this gives you our value. All right. So to put on this trade, you would be buying to open both trades, quantity 1. Okay. August expiration, $85, same strike price. Remember our example, one strike price for both puts and calls. And then we have your bid and your ask. So the nice thing about the platform is it already tells you what it's going to cost you. Okay. So you're obviously paying the ask. So it's $7.40 or $740. Okay. So for this position versus the last one, if you think about it, is in a pretty decent shape because we know one of two things is going to happen, or one of three things is going to happen. The market's either going to reverse and become a bull and rally, or it's going to stay neutral and go nowhere, or it's going to go lower. Now, right now, the trend is trending lower. So the odds are towards trending lower initially, There's no sign of neutrality because it hasn't given us a reason to think that. But there's all this news. And if we have a correction, remember, markets don't travel in straight lines. If we have a correction and it gets pushed by this news, we have a good chance at having the market move away from where it's at and not stay where it's at. So instead of using a covered call, the straddle position, I think, is definitely a much better thing to get into for this one. And we'll take a look at a couple other strategies you can use for the same thing. So if you're neutral, as far as you don't know which direction goes, you want it to move or you think it's going to move, straddle is an ideal strategy. It's a very basic one, and your risk is only what you have here. So now how much is this going to cost you? Well, I'm going to show you. We're going to implement it. You hit verify, and right here it tells you verifying result. And once again, you check your trade and you can make sure that's right before it's filled. It says buy to open. It says one contract of the McCormick stock, August expiration, 85 strike price call, 85 strike price put, estimated cost. It tells you $760. So everything is broken down here for you. Okay. So now you know that to put on this trade and take advantage of potential market volatility and movement, this would cost you, once again, $760. Okay, then there's the trade, the per trade commission for exchange fees, and the OCC. These are ones that it's not eOption. This is everyone pays this, no matter who you are. It gives you the estimated cost, and then you think that you agree that it's all good. You say place the trade. Ding, there you go. Orders placed. You get your confirmation. We got filled at those numbers. Everything's okay. So now what does that mean? Okay, well, now we go back to our account summary. Look at that. We now have a position, and it tells you the value of where it's at right now. So we know our P&L for each option, where they're at. We know what the opening price was. We know the market value. Okay, so right now you can see our account value is still there. We have a market position of $720, and this will fluctuate as the stock goes up, as the stock goes down, and as we go out in time. So remember, there's multiple dimensions to options. So obviously there's the pricing. So as the market goes up in this position, the put value of the straddle goes down, the call value goes up. If the market comes down, then the put value goes up and the call value goes down. Now, how far do you want this to go? So we already figured out that we had 85 right here. So we go back to here. Let's see what our cost was. Okay, so we know it cost us, what was it? It was 700, and what was it? 760. Let's see, we go to our, where is it? Oh, positions and orders. Here we go. Okay, so we know right here what our price was. It was 760 for the option position. So now what we're going to do is we're going to change the color of these lines. So 760. So from 85, that would put us at 92.60. So 92.60. And we're going to change the color of that to, let's make it black. It's very easy to see. Okay, and the same thing would be below here would be another 760, but that goes below our chart. Okay, so we know now for our straddle to break even and make sure that you at least get your money back, the market has to at expiration be at 92.60 or above. Okay, or conversely, it would be down. It would be 760 below 85 down here in the 70s, and that would be where at expiration. So when this meets here, make it a little clear. See how these two join up. We have our expiration date here, and we have our strike price. This is the line in the sand here. At expiration, if it's here or higher, you have all your money or more. Now, if it's just short of it, you will have most of your money. You're not going to have all of it, but you will be just shy of it. Okay. So depending on how far, like if it's 50 cents away or $1 away, because the put or the call value in the straddle will be there, the put value will not be there, because that once the closer you get to expiration at these levels, it will have no value. Okay. So going back to our platform here, we go back to our account summary. We have this trade on where we know that we've broken down from looking at the stock that if the trend remains the same, we have, and also the overall market's under stress, there's a good chance that we could take out the lows that were already in place. And remember, that low here is what? This low here is 81.59. Okay, so that's already halfway there. So now there's a time value too. So let's say you get this move and we get an explosive rally and it comes up into this area here, and it happens, say, in a week from now or 2 weeks from now. Well, remember I said that the value of your position will be equal to what you paid for it at expiration here. Well, if it's before expiration and it's above it, or even just shy of it, it'll be worth more than the value that you paid for it. So that time premium will be still built into there. The volatility will be there, and that will give you a little bang for your buck. So you don't have to wait until expiration to take off this straddle. Okay, so let's see if there's any questions. Okay, let's see. We have one here. I mainly do directional calls and puts with delta is usually a good number. In your experience, I usually try to get them in the money. Yes. Okay. So for the question or the statement here is that this viewer here trades both puts and calls, and what delta is usually a good number in your experience. Okay. This is a question you're getting into the Greeks, which might be a little complicated for some of the people out there. So, so for the change for that number, it depends a lot, one, on the equity, or if you're trading a very thin market or a very liquid market or an ETF or, just an outright stock option. So the deltas for there, what's a good delta? It depends, because you have other Greeks that influence it. So at one point, depending on, say, how the VIX is going or not going, let's say it's going really pushing new highs. Okay. Your delta could skew depending on how volatile, or like, for instance, something like Tesla versus a stock, say, I don't know, it would be a really low volume stock compared to that, but comparable something. Yeah, I guess you could probably look at something like Walgreens versus Tesla or something like that. The delta, what would be good for a Walgreens is not necessarily the same with Tesla, because remember, like Tesla, you have PE earnings and a whole bunch of other things that are so astronomically skewed that delta is going to be skewed as well. Okay. So I can't give you what's a good number, because it depends on the situation. You have to break down the values. And that would get really, I think, a little technical for people here. I know at eOption, they have some stuff, some information that is all about delta that people can look up. It's definitely one of the variables that for when you're trading outright puts and calls that you need to look at. But once again, what's a good number? It depends on which market you're talking about, and also those other Greeks come into play to know if you have a fair number for that one. You can't just say that what's good for one is not good for all, is basically what I'm saying. Okay, next question. What are your main strategies? Would you consider yourself a reactive trader who likes directions? Are you more a naked call put selling? Okay, wow, we got some good ones. Also, do you think SPY is near a top? Okay, all right. So once again, this is an education webinar. We're not giving you trade recommendations, but I can give you a perspective on this. So we have multifaceted questions here. Just really appreciate this. Okay, so we'll start out. What are your main strategies? Okay, my main strategies are that I keep it simple. First of all, I don't overdo it. There's so many indicators out there that the more you study them, the more you realize that most of them come out to very similar numbers to begin with. So I keep it simple. I use Fibonacci. I use basic trend analysis. I do use a little bit of Gann analysis. Fibonacci is mostly for finding corrective pivot points and areas, as well as projections for breakouts. Okay. I use those coinciding with even basic, trend line analysis, just for trends and for breakouts. There are some certain simple patterns that I use. I use head and shoulders a lot. I don't use so many like wedges and things like that when it comes to classical bar charting strategies. But I do use head and shoulders, reverse head and shoulders. I use, like Gina said, I'm an author. I wrote a book, High Probable Japanese Candlestick Patterns. Some of the biggest, well-known and most useful patterns I highlight in that book, those are the ones I use. I use those strategies in all markets, especially even for options, especially like for instance, let's say like McCormick, this is a really good question, is let's say that we had a high probable Japanese candlestick pattern, which guess what? Yesterday we did. So since you brought it up, what would I do on my strategy? One of the reasons I like the straddle strategy right now that we put on right now is because we made this higher move low, which is definitely, even only it's a 2-day event, you can see from how far we went there and we came all the way back down here, so close to our daily low there. Okay, so being that we've had that much market movement, we've established we went from this lower move high, lower move low, lower move high. The question is are we going to fall through and make a lower move low, or are we going to break out to the upside? This here is a bearish engulfing line. If this bearish engulfing line is good, it should get down to at least a 50 to 0.618 retracement. It already did. So the trade signal is actually over. So now you're definitely looking for or I would be looking for a breakout of these 2 points. So if I was doing it myself and did not own the stock, if I owned the stock, it would be a different story. I'd be looking to hedge it in some way or protect it possibly. And I could even use a straddle to do so. But in this case, we just came off a lower move high, almost made lower move lows. And we know there's a lot of news. So the odds of us staying stagnant and flatlining, especially for the next, say, 51 days, is very unlikely. I mean, in 2 days, look at the market movement you've had. So for us to move, say, $7 once again from where we're at, does it mean it's going to happen? No. But these are things that I look for. So now this here hit and already hit its target. So now this low from today and the high from yesterday is key. So if it goes above here, I would expect it then to be challenging these areas here that we drew up before. Okay, so that puts us up at 91. Now for the straddle, for instance, it doesn't matter which way it goes, as long as it goes up or it goes down. So for instance, like today, it's had such a rebound off of the news and earnings that came out. If buying comes into, let's say, the next few sessions, and let's say there's a big rally in the S&Ps and the Russell and the NASDAQ and the whole broad market goes up, what would that do? Well, if it takes out this high, you're already confirming a neutral trend. Does it mean the overall trend is changing? Absolutely not. Short term, it does give you an idea that the bias will be towards challenging resistance and not testing support. So that helps to go for those targets. Okay, so that's right there as far as strategies. I use those strategies to figure out, do I think the market's stagnant? Do I think the market's trending? Or do I think the market has a chance at breaking out and reversing trend? Now, I'm not trying to ever pick a bottom or a top, and I cannot say this enough, do not ever try and pick a bottom or a top. That's the beautiful thing about option strategies. If you didn't use options in this case, what are you going to do? Short stock? I would never suggest anyone do that except for someone with deep pockets and a lot of experience, and they really have to know what they're doing. Okay. Would you buy a put? You could buy it yesterday after the close, or it would have been a great, or right around the close or on the opening today would have been a great day to buy a put. You know, it's actually like today with this range, if you would have bought a put on the opening within just a few hours, probably, yeah, look at this, it opened. And then the very first hour, you would have had a move of, let's see, if you bought a put on the opening, and you would have had a $3 move within just literally, less than an hour, half an hour. If you were trading outright and an options trader who was totally day trading, that kind of thing, you would be in and out. But that's not a good deal unless you're really focused on that. You got to be a professional. I would never suggest any of you do that. So that's why we said in this webinar, don't follow what we're doing here. We're discussing and teaching you how to implement these things as well as weed out the good from the bad. Okay. And also you want to know, remember when we go back to our platform here, we're covered either way. We bought the put and the call. So if we have that breakout, even if it doesn't go all the way to our break-even point at expiration, we know that most likely we're not going to lose the value of the whole position. The odds of it staying where it's at, and it could very well, if we wait till expiration, end up being right where it's at right now. But the odds are pretty good that we will make money on this position. Now, this is a good thing too, is that let's say that you own the stock. Instead of using the covered call, you put on the straddle. If the market is that bearish, and even if it just makes new lows by a little bit, you could get out of your straddle because you're already going to be up money on that. And then that money is padding your loss on your downside move for your stock. In fact, once it gets to a certain point, you can always readjust with another straddle or another strangle. Okay. So let's see. Would you consider yourself a reactive trader who likes all directions? Absolutely. I am not, I don't discriminate against directions or markets. I trade any market. It's all just buying and selling numbers to me, to be quite honest with you. But yeah, I am both. I look depending, I try and trade with the trend. I look for, but counter trend trades, I don't always take. So for instance, like I said, don't try and pick a top, don't try and pick a bottom. A market's breaking, don't try and catch a falling knife. It's going to cut you. Okay, it's going to cut you. So think about strategies for when markets are doing those things. That's what I do. That's what this webinar is all about, is trying to disseminate when you know what the trend is, you know at least what trades not to take. And that's one of the biggest things I try and instill in even veteran traders, and they agree with me too. It's anyone can put a trade on, anyone can exercise some sort of strategy and implement it and try and figure out how to work it. But that's not what trading is all about. It's about making money. And the reality is knowing what not to do is more important than knowing what to do, because there's a lot more things that can go wrong than can go right. There's only so many things that can go right on any given trade. So knowing when not to do things and definitely what not to do and to avoid. Like for instance, in a downtrend, you don't put on a bullish position unless you are viewing it as a corrective move, a counter trend position, and you're aware of those risks. Okay. Not that there's not risk trading with the trend. You can still get caught when, all trends do turn. Eventually, if you're riding a trend, you're not going to get out at the very bottom. It's going to come back and you're going to give back some house money, but that doesn't matter as long as you don't get greedy. Pigs get fat, hogs get slaughtered. So the whole thing is to keep trading as a business or investing as a business, and don't treat it as gambling. So let's see. So there's that one. Directions. Are you more of a naked call, put selling, call, put spread? Naked? No, that I don't do, but I am big on selling credit spreads. I am big on using, especially for instance, like in this here's another great, let's go over this one here. We can use, so for this one, we can do a bull spread. Yeah. Okay. So for instance, like here, we had this nice bottom here. We had the sell signal. We hit support. So I'm not going to try a bottom here, but let's say that I like the numbers and the analytics that have come out today. And I'm thinking, you know what? I don't own the stock. I don't want to own the stock because it could go lower, but I want to minimize my risk, but take advantage of a potential run up at resistance. Because remember, we bounced off strong support. We're almost unchanged on the day. This is a very strong momentum to keep it going. And there's a little gap here between yesterday and today. Old trader adage, all gaps get filled eventually. Does it happen right away? No, sometimes it takes years. But for the most part, they usually do. So here's a little bullish indication. So let's say we want to get long. How about we do, let's see, for bullish, we do a bull call spread. Okay. So now that's one way where that would be buying a spread. Or what you can do is you can sell the credit spread below it, the put spread. Okay. So that's something where you would be selling the closest put and buying the further output. But now we got to figure out levels. So let's see, we're here at 85. And let's see, 80 is where? So let's draw a strike price. So we know we can work with the 85 and the 80. Let's make this real clear here. Very good way we're running with this. I like this. Okay, so you can see with this color, the long line here, we have $85 and we have $80. So let's say we're bullish here. You could take money right off the table right away. And if your trade is right, you know what you're going to make right off the bat, and you know what your risk reward is right off the bat. Does it need to go all the way up to $150? No, all it's got to do is stay above these strike prices between now and expiration. So as long as the market's trading right now is at 85.69, as long as it's staying above 85, all the way out to expiration at any time, you would be able to liquidate the position at a profit. Well, right now, if you did flipped it second to second, you couldn't do it. But with 1 day or 2 days, the time decay, there would be a little bit of profit. So how would you put that trade on? Okay, so we're looking for go back to our trading. We go to strategies. and we put on a bull put spread. Okay, so we go to, we have the 85, the 90. So we want to do, we want to do this. We want to change this to August. And then we want to put this as the 85. And we're going to buy the 80. Okay. And these are all puts. Okay. Now, let's be clear here. So once again, we are buying to open one leg and we are selling to open one leg. Now, this is a basic strategy. This is not an advanced strategy. This is a very, very simple strategy. Okay. So now the risk you have, or the strikes you're dealing with here, are $5. Okay. Right now, oh, whoops, we didn't put, we got to check, keep that on the right month. Okay. So we got the buy to open. This is the lower one. And then we have the sell to open at the higher strike price. So we have the same expiration month, different strike prices. Remember, we have the 85, which is just below the market price, and the 80 right there. And then put. Okay, and here we have a credit of $260. Now, you know what that means? We have $5 in between our strike prices. We get a credit of $260. That means right now you would be, or actually it would be $190 actually, because you're selling it. So you get $195. All right, so your risk is just over $3. So if you are wrong, you know that you would lose the difference of the credit minus that gap in fee. So you have $5 of risk. You have $195 that you already have. Okay, so that would mean that your risk would be just that 300 whatever. And then if the market goes up, that 195, that's all yours. Okay, so it doesn't matter that it goes to 100, 150, as long as at expiration, if it's at expiration, you get the whole 195. If you get out of it before expiration, which you could do, and it probably would be the right thing to do, is if you have a big rally, you have a bunch of time premium involved. Now, here's the thing is, time premium is neutral here because you're buying and selling. So that one doesn't mean anything for the value. Okay, that's just a matter of how much time is left. Okay, so now if you don't have much time left, or even if you've gotten, especially if you've gotten up here very quickly, well, why risk the time? There's no time value as far as your options and pricing. Volatility is also neutral because where it hits one, it balances out because you're buying and selling. It's kind of a neutral to a lot of the Greeks when it comes to that. So you secure your 195, you're all good to go. And if the market goes down and it makes new lows, well, you didn't buy the stock. If you bought the stock, you'd be down a lot more money already. And if the position goes down, goes south, well, okay, well, you only lost what you knew you were putting up to risk. Okay, so that's a nice little trade right there. And that's where, when it comes to like selling spreads, those are the kinds of spreads I look to do. Now, I also will do a debit spread where it actually costs me money. Usually that's a little bit of a different scenario, but I like credit spreads for, especially if I think where I would rather go, if I want to be long or short, basically, and that's my directional bias, that's when I would use a credit spread. Now, you can do the same thing to the opposite, where you're bearish and you would do a call spread. Okay, so you're above the market, you would use a call spread. Below the market, you'd be a put spread. If you're bullish, then you would do the put spread, and if you're bearish, you would use the call spread. So you know how like people equate calls with up and buying? Well, this is how the spread works, because you're buying the closer strike price and you're selling the further out strike price. Okay, let's see. So we got another question. Also, do you think SPY is their top? Okay. So yeah, I can't give you any trade recs on as far as what do I think the SPY is doing. And I was in the SPOOs for over 20 years in the S&Ps at the Merck. Yeah, the market's definitely very volatile, that's for sure. As far as topping and what have you, you got all kinds of inflation data. Recession is definitely around the corner. Here's the one thing I have to tell you when it comes to the stock market. Besides the fact that it's been going up basically my whole life, there's only been a few bearish periods. Recessions come and go, And in some of the worst environments, the stock market has its biggest rallies and accelerates. There's been ideal economic environments in my trading career where the market's tanking and there's nothing but good news, so is there a bear cycle coming? You know what, eventually, yeah, we're going to have another big sell-off. Is it coming now? I'm not going to get into those. We're not doing a breakdown on the broad market analysis, but I would say there's a lot of opportunity with the SPY with the options. I'll give you that. And that would be another one too, where I would look into credit spreads, where if you're really expecting a lot of movement, indexes are very volatile. They are not for the beginning trader. So I would hope that you've got a lot of experience, unless you really are focused on it, because it jitters around. It has a lot of noise. It's not like, like we're looking at McCormick, for instance, that has news that we can look at. It equates to a very small thing. SPY, you're looking at hundreds of different stocks implicated by there that have influences by multiple markets and things like that. So volatility is there. Credit spreads are great to trade there. Straddles and strangles are another great strategies. They're beginning ones, but they're also ones that that advanced traders use too. And then I would also look at some butterfly and iron condors as well. So for the SPY, so I'll give you that advice on what would be good positions depending on whether you're bullish or bearish to use, and also mitigate your risk and give you a lot of bang for your buck. There's a lot of reward for the risk that you're taking, and those are ideal money management components that. Besides knowing what spread to put on and how to break down a market, folks, money management is one of the biggest keys to your success as an investor or as a trader. Just because you find a trade that looks good, like for instance, we'll put on this one here, this credit spread here, where once again, you verify it. Oops, see, I can't do that one. Oh, look at this, rejected, so short, cannot be placed in long positions. That's right. You can't do that. See how it corrects you? Isn't that nice? So if you don't put the order in right, you can't get the strategy right. Plus it also moves, so we can't get the same pricing. Once again, yeah, I would, for the SPY, I would use those strategies, and there's plenty of information on eOption.com on how to implement those strategies as far as examples on what kind of strike prices you would be using and stuff like that. Let's see, next, let's see, I'm getting into purchasing at the far, yeah, I can't, that one. Okay, for the purchasing, okay, so here's a good question for time value. He wants to go far out in expiration. So we looked at our example of 25 to 45 days, basically, it was just over. If you're going to go out really, really far, that's good for long-term trading ideas. Obviously, it's not for short-term news. You're looking to capture a longer-term trend. That's how you have to do it, is you have to use further out options. The key to further out options, though, is that you have a huge time component. So that's irrelevant. That's value is not really going to factor in much, because the further you out, you have a lot of it. I would just be cautious to make sure that if you are buying, if you're doing spreads and you're selling spreads, try and sell it in high volatility. And if you're buying, try and buy it in lower volatility. So maybe try and gauge that. That would be important as far as using that. Now, as far as whether that would be a good put, once again, I can't give you information on that for this webinar. So let's see, next question. Given high IV, is it better to sell premium? The high volatility, selling premium, absolutely. Is it depending on the different spreads? That is a very good idea, especially like, for instance, when you're doing a covered call, that scenario you want to sell during high volatility. If it's low volatility, you're not getting as much insurance as you could. Remember, covered calls are not a full hedge anyhow. It's just like a little dividend that you take yourself. You might as well take as much juice as you can. And I suggest that if you're in periods of low volatility, it's not even worth taking that trade, which once again gets back to, it's not about placing trades. It's about knowing what trades definitely not to do. That's why you want to know what side of the trade, like you don't try and play a bullish play when you know there's a severe downtrend going on, unless you're trying to trade a correction, to the upside. But then you're aware of the fact that you're taking high risk with low reward, which then also goes against really good money management rules. So we got couple more questions, and then I got to transfer it off. So let me see. Does short straddle work the same way? No, if you're short a straddle, that's the opposite. You're selling the options. Then you don't want it to move, because one leg one leg will be good, one leg will be bad, but you're going to get exercised on that, or it's going to go against you. So yeah, that's a good question. Now, if you interwove a short straddle with another long strangle, then there's a different story. So if you're doing outright short straddles, I would say you got to be a more advanced trader, and you have to understand the Greeks and understand how much time premium you will how much time will move where you have to leg out of part of it, to protect yourself. So your risk is unlimited or close to unlimited by selling a straddle versus buying a straddle, unless there's some other legs that cover or are used in unison where you can buy a straddle and buy a strangle. Good question though. What is your outlook on oil prices? Well, I can tell you that I'm a bull. If you look at my videos that I do and some of the other spots I do for other financial shows, I've been a bull for over a year. I got the $100 call. I use those trends. So here's the thing: is the trend is your friend. So for oil, you can use that for certain oil stocks. The more oil goes up, guess what? They don't set the price of oil. They just drill it. Demand sets the price for oil, and they're getting a big premium. So right now it costs them in America, I think the break-even point on oil production is like around, because of Warren Buffett has now got the mandate that he's the only one that can ship it by rails and stuff. It's probably $35 a barrel right now, which is still pretty expensive for a cost. It should be much lower, but because of mandates, that's higher. So right now they're making, $70, $80 a barrel versus if it was trading at $40, which is what it should be with the demand and summer and what have you. But yeah, that's as far as that trend. Now you can trade options on the oil markets too. So I would definitely look into some straddles and strangles, because the volatility and swings, you can't make this stuff up, folks. I mean, you don't have to be an analyst or a trader to just got to go buy gas and you can understand the fluctuations. All right, I'm going to do one more question before I turn it over to Gina. Pattern if you balance good. Okay, you have a question about pattern day trading. I could answer that question for you, but that's something you want to talk to eOption about. They can totally explain that to you, and that's not really going with what we've been using on the webinar. Add about the option price. Yeah, let's one last one. Are there any SPY index you look at before you enter trade? Okay, yes. As far as indexes, good question. Before whether it's currency markets or stocks and options, I do look at all the major indexes. I look at the S&P 500, I look at the NASDAQ, I look at also the DAX, I look at the FTSE, I look at the Nikkei, I look at the major indexes around the world to kind of get a pulse on where those trends are, because how all markets are interrelated and they impact each other to some degree. So yes, I do use those for trend analysis to get a bias where if I see foreign markets falling apart, and even though we may be very bullish in the US, I will not be as bullish. I won't expect as much of a breach of resistance, if you will. Or let's say if the foreign markets are really, really strong and we're bearish here for whatever reason on any given day, if they're really strong that day, I won't expect as much of a sell-off as you might normally get. It's a great question. Really appreciate that. Let's see, it is now I get one last one. What do you think DE and CAD have imploded in the last they have, and I would expect that to continue. I think that is something you can definitely, I wouldn't say bank on, but I would expect to see a little more follow through when it comes to both of those. And with that, I have to put something else back up for us here. Let me get this. And all right, I'll turn the mic now over to Gina. And is it not moving? There we go. Okay, here's the screen for Gina. All right, thank you, everybody. Great questions. I appreciate your time with us today, and I hope you gained a lot out of it, and hope to see you guys again soon.
Great. Thank you so much, Teddy. And just a few reminders before we go. There are a lot of excellent questions, and thank you for sending those over today. If you have any more questions, we're happy at eOption to answer any of those for you. You can shoot us an email at support@eoption.com. You can also look on our website for our phone number, and our staff is happy to talk to you. And we're very responsive. It's easy to get through, and we're always happy to answer your questions. And just to point out a few things on the screen, we do offer some of the lowest rates in the country. We're zero commission for unlimited stock and ETF trades, and options are just 10 cents per contract. And as Teddy pointed out, our trading platform is very easy to use and intuitive. We have an excellent mobile app, and we offer all kinds of free trading tools. And one of the ones that Teddy briefly mentioned was Options Play that he showed you on the platform. Now that's for our account holders. And basically, that's an online tool that scans thousands of stocks daily and highlights potential option trading ideas for you. If you're looking for ideas in these volatile markets, now that's normally $500 annually, but we do give that free to our customers, and it's an excellent resource. So we encourage you to go to our website at eoption.com and check that out. And you can also see some videos on YouTube, our YouTube channel, how to use that. Also, Teddy mentioned some strategies during his webinars. He mentioned the Greeks and delta. He also mentioned some terminology such as straddles and strangles, and credit and debit spreads, and butterflies and condors. If you want to learn more about those, please visit eoption.com. We do have an education tab, and we have a strategy page, and it's really excellent. You can click on whatever you're interested in, and it'll give you a summary and examples, and some of them also have videos. So we encourage you to check that out if you're interested in education. And then the last point is that we do have a YouTube channel. We have lots and lots of option trading videos on there by experts for whatever you're interested in, for whatever level that you're at. And if you're interested in getting a copy of this recording, it'll be available on our YouTube channel tomorrow. So we encourage you to subscribe so you don't miss any of our future trading videos. And as a special feature, if you look at the video, we will have a special promotion there. So if you're interested in opening an account with us, we'll give you free stock, and there's a promo code on the YouTube channel. So make sure you check that out. And just a couple other quick points. Teddy used our paper trading account. Now that's a free account. If you want to test your trading strategies in this volatile market, we'll give you $100,000 in virtual cash where you can practice. And all you have to do is go to eoption.com and click on there's a free demo account button. It's a big blue button towards the top, and you can sign up pretty easily there. But if you are interested in opening an account, we'd love to have you. If you go to eoption.com, you will see an open an account button on there, and there is no minimum to open an account. And one of the excellent things about doing that now is that there's no minimum, and you also have all of our resources available to you, including Options Play. So we encourage you, and just to have it ready when you're ready to make that trade. We get rave reviews about our trading platform, that it's very easy to use and intuitive, as Teddy pointed out. And it's excellent for stock, ETF, option trading, whatever you're interested in. So we're very proud of it, and we hope you'll get a chance to check it out. So on that note, I'm going to sign off, but thank you so much for your time today. We greatly appreciate it. And we do plan to have more webinars this summer, so we will definitely let you know. Thank you so much, and bye now.